So what I'd like to talk about is innovation, but I'd like to talk about it in the context of the crisis. And of course, innovation matters a great deal, and I think it matters an enormous amount in light of the crisis, and I think the crisis itself magnifies the need for innovation and the need to figure out different ways to become innovative in the Spanish context, but also in the global context. So let's just have some context about the predicament that the world is in. And if you look at this now, this is the projected default rates for for bonds in the U.S. And if you look at regular loans and high yield bonds, you see that the projections are that we're going to have essentially 4 times the default rate over the next 2 years. Now that's an enormous shift in terms of an orderly, predictable market into something that is chaotic, very difficult, and that even though interest rates are very low now, indicates that we'll have high costs of capital and constraints on growth. This is, I'm just wondering if we could have, this is is this making a lot of noise here? Is that better? Okay. If you look at this chart, this is the Dow Jones Industrial Average. And if you look at the different crises that we've seen over the last 60, 70 years, you see that while this has been very steep, it looks like the crisis at present is probably ending, at least on the equity side, and that we may have hit bottom, at least in the U.S. We're not sure globally, although it looks like the same factors are at play around the world. But the major factor here is to take into account, again, the high cost of equity. And what has happened, people look at the fall in the price of stock, and they think about their own portfolios, they think about the difficulty that they may have in retirement, they think about their own loss of wealth. But the major impact is really on the cost of capital. I mean, what we've seen and what we're likely to see going forward are greatly elevated prices, particularly for equity capital. And that's a very difficult situation, and it only makes the case for innovation greater, given what we're likely to see. Now, the global financial crisis wiped out trillions of dollars. We know that. This is the amount that we have lost. Now, much of these losses are on paper, but they still indicate a tremendous loss of wealth globally that we've all had to endure. And this is a situation that we're all feeling very personally, but also in terms of the engines of development and growth around the world. The various corporations have seen their currency devalued as a result. This is where we are in terms of real GDP growth. We've seen a very marked decline. When you consider a 4% decline in the advanced economies in terms of GDP, this is an enormous amount of loss in terms of the current situation. Now, I have to say, in light of all these terrible statistics and these steep declines, I remain an optimist with regard to our ability to come out of this situation, and I'll explain why. But I think, at least in the medium term, we certainly have a very difficult situation. The deficits, these are going to be very major problems going forward. Now, a lot of people, particularly in Europe, look at these deficits, they look at the funding of these deficits, and they're very concerned about inflation, rightly so. But I look at it from the standpoint of overcapacity around the world because of the sharp decline in production, the sharp decline in consumption. And my worry is really more in terms of deflation, because the tools that we have for addressing the concerns of deflation are really not anywhere near as powerful as the tools that we have for addressing the problems of inflation. So where it's a kind of legacy in Europe to worry about inflation and to create policies around that set of circumstances, in the U.S., given the history and the deflationary period of the 1930s, the tendency is to look more toward what can be done to prevent deflation. So we have a convergence, an end of a convergence of points of view as Europe looks toward the inflationary perspective and the U.S. is looking toward deflation. Two different views of the world. We don't know which one is right, and we certainly can't treat both at the same time. Now, these are just another statement of the losses that we've seen. These are extremely big in terms of declines. If you look at Japan, Japan has just been hurt enormously in terms of GDP declines, but so has China. China is gone, it's still positive, but the question mark with regard to China is it growing at a rate in this particular crisis that will enable it to continue to absorb people from the countryside into the labor pool? Will the engine that right now is driving much of the world in Asia continue to grow if China is at 6.5%? Now I have to say as an aside here, having looked at China and the Chinese economy for a long time, I have to say the Chinese statistics are never accurate. So we see 6.5%. We don't know exactly what it is, but we presume it's less. There's kind of a tendency in China to overstate growth, overstate the positive side of their economy, to bring in more investment, because if you consider the enormous number of people who have to be absorbed into that labor pool, who have to be taken from the rural areas and moved into the urban areas to keep that economy growing, it's huge. And so we assume that China overstates. And we have the same approach when we look at Russia. We always assume Russia understates for other reasons in terms of making its economy look smaller and its growth rate look worse. So if you look at this, we're talking about very significant declines, some real question marks with regard to China and elsewhere. The U.S., which has functioned, as everyone knows, as such an engine of growth for the world, is not functioning in that capacity right now, and we have issues there. So global deflation risk, this is at least my view, has risen. And this, to my mind, is the real threat. Not everyone agrees with this. I see people already shaking their heads. But in fact, deflation is a real risk. Now, a lot of people have talked about emerging markets. And will the emerging markets be able, because they're still positive in many respects, will they be able to pull the rest of the world out of the predicament that we're in? We have a little technical approach here. Okay. Will the emerging markets be able to pull the rest of the world out of the slump that it's in? Well, I think there are engines for pulling the world out of the problem period that it's in, but I don't think at present that they are going to come from the BRICS countries. The reason is that in the aggregate, they're still too small in terms of overall demand. So in a world where essentially we're demand constrained right now and we have to create more demand, it just doesn't exist at present in the BRICS. The only exception is China, if in fact it's growing at the same rate that it says it's growing. And if that's the case, it has the power, at least in Asia, to propel some of those economies up from where it is but certainly not Europe, certainly not the US. Now, this is an interesting picture here, and I don't know how clear it is, but what it shows to a certain extent is that, you know, when we began this problem period, we had an enormous amount of coordination. The first action in the US when Fannie and Mae and Freddie Mac collapsed was to bail out those two institutions. Now, one of the major reasons for doing that was because the Chinese held almost $1 trillion worth of those mortgages. So in essence, the bailout of Fannie Mae and Freddie Mac was a bailout of China. It was a gesture of goodwill, more than a gesture. It was a significant act of goodwill to bring the world together in the face of this tremendous calamity and have everyone work together. And if you see the various actions on the left-hand side, you see that in fact the world was pretty coordinated at the very beginning in terms of its policies. But as time has gone on, we've seen a kind of difference in approach. Some of it is characterized by Europe's fear of inflation, the US's fear of deflation, and so we see something of a widening and an end to that brilliant coordination that we saw at the outset. Then, if you look at the BRIC countries, and I was just in Moscow, and I know Mark is on his way, you see something very interesting in that you see that China and India are pursuing the same path as the West. But Russia and Brazil are going in a completely different way. And in fact, if you look at the target rates of interest, if you look at monetary policy in Russia, if you look at what they're doing in terms of trying to work with their economy, they're almost taking what we in the US consider to be a Herbert Hoover approach, which is to say they're doing the opposite of what needs to be done. They're constraining the money supply, they're raising interest rates, they're trying to keep their house in order and organized, well, orderly and so forth, but they're constraining demand. And right now in the world, the major factor is demand has to be increased. So it's interesting to look at Russia and to consider what they're doing, because it's a very different course from the rest of the world. Now, world trade, very important in terms of innovation, and world trade has really fallen off a cliff, down essentially 11% from 06 to 08. I mean, this is a very significant drop in world trade. We see it hurting many, many countries. It's very difficult to project forward if we have a fall off in world trade. So now you're asking, why am I optimistic with all this? Well, one slide before I get to that, and that is if you look at the financial crisis, someone, Mohammed El-Arian, who ran the Harvard Endowment and now is the co-president of PIMCO, which is a fixed asset management firm, wrote a book about the markets and the collision of the markets. And he was just at a meeting that we had, and he said something I thought was very brilliant. And that is, this is not a crisis in the financial system. This is a crisis of the financial system. And if you look at crises of financial systems, the ones that we've had in the past, you see that they take a very long time compared to other types of downturns to correct. And this chart is the average time of recovery to the previous peak. And if you look at this, you see that financial crises take on average 5.6 quarters. And that's a very long time in terms of building back to where we were. compared to other types of financial problems that we've had, whether it's oil shocks or fiscal contractions or external demand shocks. So this is a problem that we have that is likely to last a little bit longer than many people think. Here's of course, the major culprit, and I stand here as a representative of the problem country that caused all of these issues here with the tremendous growth in mortgage debt and with the way it was handled. But I would argue that, in fact, we have to look at, when we think about innovation, we have to also think about financial innovation. And the financial innovations of the last 20 years, which included things like securitization, collateralized debt obligations, all the tools and techniques are not the culprit in this problem. In fact, these tools are very, very useful tools and have a lot that they can do to help in terms of put us back on growth. And if we lose the securitization market, we lose an enormous source of capital that will be very, very important to us as time goes on. And that would be an enormous loss if we were to lose that market, as many people are talking, as new regulations are pointing toward. The problem, in my view, is less the financial innovation and more the incentives of the people who, in fact, were involved with those innovations. And I recall very well how when I was a young economist at the UN, and I learned a lot about innovation at the time. We did a study and we created a model that looked at Latin America, and lo and behold, we saw that, in fact, in the 1980s, it was very likely that Mexico, Brazil, and some of the other Latin American countries would not be able to support their debt. So naively, we called together a meeting of creditor bankers, private bankers, called them to New York. We had, in those days, big spreadsheets, green pages of paper that had all of our equations on them, and that showed, in fact, this very difficult period that these economies were likely to encounter as a result of the buildup of debt and its unsustainability given commodity prices and so forth. Well, we said to all of the bankers, we had about 60 bankers in the room, sorry, if there are, I know there are bankers here, I apologize in advance, but we said to these bankers that feel free to take our material. All you have to do is sign your name. All of our reports were numbered. 60 bankers in the room, 60 bankers left. Only one banker signed his name and took the report. And as a young economist, I was very surprised at this. And I asked one of them and said, why aren't you taking our report, which is forecasting the end of the world, doom and gloom, and the end of civilization as we know it? And the banker said, well, if I sign my name on it, it shows that I was here and that people, and that I knew these problems were about to occur. So he said to me further, he said, I'm paid to make loans. I'm not paid to collect loans. That's a different group at the bank. So I learned from there, and I think that incentive system is still in place. And in fact, that's the culprit in our situation that we have. It's not the products, it's not the innovations, it's the kind of incentive systems that have been put in place that have made it attractive to make loans to this extent and with such poor credit. So this is simply some of the U.S. growth rate, but what I'd like to get into is this piece here, which is essentially showing in the U.S. Context what kinds of recoveries we're likely to have. And if you look at this, at these estimates, and of course there are really hardly any numbers here, and it's pretty vague. But if you look at these, you see that the typical recovery is at least equal to the downturn, and in some cases 1.5 to 2 times the downturn. Now, I think that that's probably what we'll start to see in the U.S. Beginning either in the very late half of the year or in the first quarter. We'll start to see some robust growth again. And when that happens, we're going to start to see some movement once again throughout the world as the U.S., the consumer of last resort, takes up his and her role and starts to purchase again. And when that happens, we'll slowly see what will probably not be the strongest economic recovery of all times, but will certainly be a fairly robust recovery. And I say won't be a strong recovery by historic means because we're still going to be somewhat capital constrained and we're likely to have expensive equity capital. Now, here's one of the indicators that shows, in fact, why I think we're heading toward recovery. And if you look at these spreads, which are essentially between U.S. Treasuries and LIBOR, you see that, in fact, they're coming back to more historic levels, and they're taking into account the risk premium is going down, and so we're starting to see at least some movement again in terms of lending. Now, it's not where it should be. It's not on the level of the kinds of lending that we had certainly before the crisis, but it is improving. Now, this is another reason why I tend to be optimistic, and that is that if you look at these numbers in terms of percent of GDP, in terms of stimulus, you start to see these are very, very big numbers. We're talking globally. It's very difficult to add it all up, but it seems that we have about 9 trillion or so that has already been allocated and that is being spent or being used to guarantee various loans and so forth to bail out the recovery. And that's a lot of money. That's an awful lot of money. It also seems that, in fact, there's more capacity there. There is still capacity in the U.S. To increase debt spending. There is capacity certainly in Europe to increase debt spending. There are very large pools of capital that are untapped in the U.S. and elsewhere. There are still, although there have been big losses in the sovereign wealth funds, there still are large pools of capital there. And if you look at the pools of capital that there are around the world, there is an enormous amount of capital. And I look at that from a positive light. I think that capital can be mobilized. And I also think that the constraining factor is not so much economic, but confidence. And that has yet to return. Now, all of that is sort of a wind-up, and I won't spend too much time, but kind of a wind-up to the topic of innovation. And one of the things that has struck me in terms of innovation is if you look at, these are just some U.S. companies that were founded over the last 30, almost 40 years. And if you look at when they were started, it really doesn't matter whether they were started in good times or in bad times. Innovation is innovation. You know, if you were Cisco, you had the bad fortune of starting at the very top of a market that rapidly tumbled after you opened your doors. If you were CNN, you started at the very bottom, at the trough. Microsoft also started at a trough. So if you look at when these companies were funded, where in the cycle in terms of GDP, you could chart this against equity prices. There are lots of different factors. You see that, in fact, innovation triumphs over circumstances every time. And the enormity of what these companies have done during either good or bad or right at the cusp of a cliff that they're about to fall off of, really indicates the power of innovation. Now, we have seen the number of IPOs really collapse. So this is another indicator of the fact that capital is scarce. We've seen it collapse in Europe. We've seen it collapse in the US. And this is typical of recessions, but even compared to previous recessions, this is an enormous, enormous fall. Now, we compile statistics on access to capital at the Milken Institute. And this is very interesting because it relates directly to Spain. Out of the 50 so countries that we study, Spain is really a country that has a very poor access to capital. It's number 27 out of 50 countries. So if you are an entrepreneur in Spain, you have a tough time raising money for your business. And this is a real negative in terms of innovation, particularly from an entrepreneurial basis. So from the standpoint of Spain, there have to be other ways to go about raising capital. The markets have to be opened up. And I look at Spain, and I'll finish with this, but I look at Spain and I think, you know, there is an example in Spain of something remarkable that has been achieved in the area of innovation. And many Spaniards are unaware of this. But outside the country, many of us look at Spain with a lot of envy. And that is in the area of solar and wind. Spain has really, in a very short period of time, become tremendous energy, number 2 in Europe, and in terms of energy from alternative sources. Now, the means of doing it has been very, very simple. It was not from allocating venture capital to entrepreneurs. It was really when utilities were given access to a steady and predictable source of funds in terms of what we call at least a feed-in tariff. That feed-in tariff, which guarantees the rate, same system as in Germany, same system as in Denmark, has led to an enormous amount of innovation and also entrepreneurship in terms of spin-outs of utilities that have formed companies that have aggressively pursued this new market. Now, that's something that I think in a constrained economy, in an economy where capital is likely to be, certainly equity capital is likely to be expensive for some time to come, and an economy that doesn't traditionally make capital available to entrepreneurs, the example, the case of Spain and its alternative energy sector is really something worth studying and applying to other sectors. And it has worked wonders, and in many cases, it has been invisible if you are in the country. So I'd just like to finish with that. We have done studies of entrepreneurship. If you want, I can go into some of these later. These are some of the keys in terms of studying 360 startup companies, what it takes to succeed, but I'll leave it at there, and thank you very much.